Hey, what's up guys? Welcome back to the channel. So over the past few days, there's been some absolutely insane volatility in the stock market due to, well, of all things, Reddit. So what's happened is we're seeing a head-to-head of the r/WallStreetBets Reddit thread and hedge funds. So the army of Reddit memers have taken on Wall Street, and for a while, it really looked like they were winning. But now Wall Street are starting to fight back, and we're starting to see what's actually happening behind closed doors. So let me give you some background on this whole situation and explain exactly what's going on and what impact this is going to have on the market in the long term. Firstly, what the hell just happened? GameStop shares just rose by over 2,000% in a month. Out of nowhere, they went from $4 a share to over $400 a share. It doesn't make any sense. Did they come up with some newfangled technology that completely defies logic and is going to be the next big craze? Or was it just some Reddit memers? Well, to explain this, first, we need to go back.
Marty! You've got to come back with me!
So we're back in September 2019, where a Reddit user, which goes by the name, which I can't say, but I'll blur it out up here, DeepValue, he posted on r/WallStreetBets that he had just bought $50,000 worth of GameStop's shares. Now, at the time, everyone reacted saying this doesn't make any sense. Good luck selling those shares, nobody wants them. Because GameStop is a company that sells physical copies of games and gaming devices. Everything's moving digital, so surely this is going to get left in the past. Think CEX in the UK, or SEX, however you pronounce them, but on steroids, and even more dedicated to lowballing you, so when you offer them a new PS5, they give you about £2. So for the next year, this Reddit user, DeepValue, updated their position in GameStop around about once a month, and at certain times was down $20,000, $30,000, but was buying more and more shares in GameStop, and people couldn't understand what was going on. But by September 2020, people started to cotton on to what was actually happening and started realizing that maybe this user, DeepValue, wasn't so crazy after all, and maybe he just spotted something that all of the others missed. So you see, what DeepValue noticed was that actually from a financial position, GameStop was in quite a good position. They had cash in hand to be able to pay off all their debts, yet they weren't paying them, and they were investing in a new CEO and a new business strategy. Something was afoot. But what he also noticed was the percentage of shorting that was happening on GameStop, and this is what led to the perfect storm. But first, I'm going to need to explain what shorting is in a very basic sense so that we can understand the backstory of all of this. So this is a brief introduction to shorting and how it basically works and how this mess happened. So step one is I borrow shares off of Elon. So let's say I borrow 5 shares off of him at $10 per share. Now, I can then either just hold on to those and return them to him later on, but that won't do anything for me, I won't make any money. Whereas what I can do is sell those 5 shares to Jeff for $10 each. So now what I can do is I can wait and hope that the price of those shares goes down so I can buy back those 5 shares at $5 each. I can then return the original 5 shares to Elon and I pocket the difference, which is the $25 difference between 5 shares at $10 and 5 shares at $5. So that's basically how shorting works. You borrow shares in the hopes that the price goes down so that when you sell them back to the original person, you can pocket the difference. But the issue with shorting stocks is that if I borrow them for $10 and sell them for $10 to someone else, and I'm waiting to buy those back at a lower price, if that price goes up and up and up and up, then I have no choice but to buy them back at a higher value, because otherwise I could lose an infinite amount of money, because technically there's no cap on how high those shares can go. So I could have bought them off one person for $10 each and have to buy them back at $100 each to give them back to the original person I borrowed them from. Well, this means I'm making a $90 loss per share. So this is how the perfect storm of shorting came to happen. So what this Reddit user, DeepValue, noticed was that a certain few hedge funds were so confident that GameStop was going to go out of business and be left in the past, they had actually shorted GameStop to a value greater than the total number of shares that GameStop had. In fact, they'd basically shorted the equivalent of 140% the value of all of the GameStop shares that were in the world. But what's worse than this is that the number of shares that can actually be traded was significantly less, because 75% of these shares were tied up in institutions like Goldman Sachs, Vanguard and BlackRock. So actually, they had shorted over 400% the value of the total tradable shares known as the float. What this means is that if the stock price for GameStop started to go up rather than down, they would struggle to buy back enough shares over time to be able to cover their short positions. That is, buying back those shares at a higher price than they borrowed them from, just to minimize the amount of loss. Well, this means that they're always going to want to buy more and more shares, so you can drive the price up and up and up, and these hedge funds are always going to want to buy those shares to cover their positions. So then we get what's called a short squeeze. So a short squeeze is where you buy as many shares of a stock as possible, and what this does is drive the price up, because you know that the people who have shorted it are always going to want to buy it at that price or a higher price to prevent themselves from losing money. So you repeat this cycle over and over and over, and because the shorters will always want to buy it at a higher price, the price rises through the roof. And this is exactly what happened. The r/WallStreetBets subreddit got a hold of this idea and thought they'd stick it to the man, stick it to the hedge funds that caused the 2008 economic collapse and profited off of it. So they started mixing political and emotional feelings with technical investing. So they started short squeezing these hedge funds as aggressively as they could to try and essentially put them out of business and eat the rich. And this is where it all kicked off. Hundreds of thousands of traders got involved on free-to-access platforms like Robinhood, Trading212, and they started buying as many shares of GameStop as they could to try and drive the price up. And it was working. The guy who had originally invested $50,000, before long his shares were worth $22 million. The price was increasing astronomically, and the short sellers, these hedge funds, were facing billions of dollars in losses. Now, if you sprinkle on top of this a little bit of support from Elon Musk and Chamath, I'm not going to try and say his last name, but this guy, then suddenly you've got an even better perfect storm, as you've got some big investors and the individual retail traders starting to get involved. And the price of GameStop just started increasing and increasing, and the hedge funds were making bigger and bigger losses. So this came to what seemed to be a climax when Melvin Capital announced that they had closed their short position at a $13 billion loss. Now, this is astronomical. They had to borrow from other investment banks and other hedge funds in order to cover this. This essentially means that they are almost out of business. But that's not quite where the story ended, because what then happened was that the platforms like Trading212, Robinhood, and other platforms of this manner that are free to access for retail traders, they started preventing people from being able to buy shares in these companies. Now, if you're removing the capacity for people to buy shares, that means that people will only be able to sell, and so the price will decrease, which benefits the short sellers or benefits the investment banks and the hedge funds. So this was seen all over social media and over the news as an attack by these free-to-use platforms on the everyday person, because they were essentially siding with these major hedge funds. So then there were calls for the SEC to investigate Robinhood, Trading212, and the individual hedge funds to see if they were colluding to create market manipulation to drive the price of GameStop and other similar stocks down in order to prevent them from making too much loss on their short selling positions. Now, as of today, the 29th of January, Trading212 and Robinhood and a few of the other trading platforms have reopened the ability to buy these shares. So we're not sure exactly what's going to happen, but the prices have started rebounding immediately. GameStop is up, AMC is up. These different shares that saw a drop as soon as people couldn't buy them have started regaining momentum, and people are starting to stick it back to the investment banks and back to the hedge funds again. So it'll be interesting to see what's going to happen next. So what is going to happen next? Well, of course, this is all personal opinion and how I think things might develop. It's just for entertainment purposes. This is not at all financial advice. But one thing I think we might see is the end of the dominance of Robinhood and Trading212 and these free-to-access platforms. And we might see a return to the olden days where you had to pay commission to start investing in the stock markets. Now, the reason I think this is that this free-to-access methodology is allowing people who haven't done much research, who are basically just trading on emotion, to go in and throw money at things. Which means you can see the perspective of shutting down the buy side of trades, because at the end of the day, people are just risking money and they're basically gambling without knowing what they're doing. But also, the whole point of these apps is to provide free market access for all. Everyone should be allowed to trade. So what I think we will see instead is other different apps starting to benefit more. Apps that didn't, for example, block their users from being able to buy and sell different assets. And I think that we'll see a shift away from the 2 or 3 big names and see it start spreading out to some of the smaller names in the industry. Secondly, we will most certainly see an investigation from the SEC into what's happened. Now, this is obviously going to have 3 different aspects that they're going to investigate. They're going to want to investigate if r/WallStreetBets, the subreddit, technically counts as market manipulation, because it was a group of people working together to drive up the price of a stock, and it technically could be seen as artificial inflation, but that remains up to the SEC to determine. Secondly, we'll almost certainly see investigation into each of the platforms that I mentioned before and a bunch of others who limited what you can trade and what side of whether you can sell or buy on certain assets, because this may be viewed as market manipulation. And finally, there'll also be investigation into the hedge funds to see what part they played behind closed doors in manipulating either the trading platforms or the people to try and cover their own positions. But it'll be interesting to see what the SEC finds on this and what the investigation returns. Oh yeah, and that guy who invested $50,000 into GameStop back in 2019, well, at one point on January the 27th, that was worth $44 million. Now, it's since shrunk to around $35 million with the fluctuations of the closing and opening of the markets. But it's safe to say, that is a hell of a return off what some people spend on a new car every 3 years. So again, I just want to repeat, this is all completely personal opinion and speculation. There's no guarantees of what will happen, none of this is investing advice, but I just find it really interesting to see from the outside looking in. When these kind of things happen, like with Bitcoin in 2017 and earlier this year, and now with this, it's really a great entertainment and rollercoaster ride to watch from the outside, but not necessarily to be involved with. Now, of course, I can fully understand the FOMO, or the fear of missing out on all of this, because you're seeing people make 2,000% returns on individual trades. But this is so completely not the norm, and it defies all rationality, that really it's just a gamble. There is no predicting what's going to happen. At this point, these kind of investments are essentially just playing roulette. So that's my take on this all and what I think is going to happen in the future, or what might happen. It'll be really interesting to see what actually develops. Let me know in the comment section if you got involved in any of this, or if you think things are going to happen differently to my opinion, because I'm always interested to hear other people's opinions. So as always, hit the like button, subscribe if you're new around here, and I'll see you in the next video.